Hello, welcome to the Global View on this Thursday. Taking a look at what's going on at a macro level, US producer prices fell by the most in 3.5 years in October as fuel costs plunged. The producer price index declining by 0.5%, with goods prices falling 1.4% thanks to a more than 15% drop in gasoline prices. Excluding the volatile energy components, goods prices edged up 0.1% last month, while the cost of services was unchanged. Meanwhile, US retail sales fell a less than expected 0.1% in October after months of growth, a sign that demand is cooling. Excluding cars, gasoline, building materials and food services, core retail sales rising 0.2%. And US Treasury yields rebounded from 2-month lows despite signs of slowing inflation. The yield on the 10-year Treasury note up 10 basis points to 4.54%, and the 2-year just shy of 4.9%. And the US dollar has bounced off its biggest drop in a year yesterday following that release of the Consumer Price Index, which showed US inflation was cooling faster than expected. The Aussie dollar maintaining its recent gains to trade at 65.1 US cents. Well, for more on that economic data, I caught up with Garry Evans, Global Asset Allocation Strategist at BCA Research. He also revealed their research, which shows economic growth has little or no relationship with long-term returns.
Certainly the inflation data that we had on Tuesday were softer, and I think it's quite clear inflation is coming down. Where I probably push back against those to say, we're still well above the Fed's target of 2% PCE inflation. The Fed itself is forecasting that will still be 2.6% by the end of next year. So the market, in my view, is a little bit run ahead of itself in assuming, as it's now pricing in, that the Fed's going to be cutting rates in the first half of next year. The market's pricing in 2 cuts by July, over 100 basis points of cuts by the end of next year. But certainly the inflation data was better, but we're just not at that 2% yet.
All right. So with the prospect of beginning monetary easing, when do you see that happening? What's most realistic, do you think, in terms of a time frame?
Yeah, so I think the simplest way of looking at it is the Fed has 2 targets, 2 mandates. Inflation at 2%, and we're currently 3.5 plus. And unemployment, they don't have a target, but they have an estimate of the neutral, which is 4. And we're currently 3 months moving average 3.7. So inflation is still the bigger problem. So simple answer is the Fed will cut rates when unemployment becomes the bigger problem. So if, second quarter next year, inflation is at 2.5 and unemployment is more than 4.5, that's when the Fed will cut rates. So I think the market's definitely being too early in thinking the Fed will cut in the first half of next year. The message from the Fed is very clear. We are still worried about inflation. We want to get back to 2%. That is our target. It's not 3 or something a bit higher. It's 2. We're still a long way to go. So they won't cut rates until they're very confident that they're on track to hit that target.
Meanwhile, across the Atlantic, Garry, what are you seeing in both Europe and the UK at the moment?
So it depends a little bit on the country you look at. There are some places like Germany in particular, the UK to a degree, where the economic situation looks pretty bad. So in both of those two, unemployment is now clearly rising. And in Germany, for example, it's obviously a very manufacturing heavy economy. We've essentially had 6 quarters in a row when the economy hasn't grown. So we've been in this manufacturing recession for 5 or 6 months or so, and now 5 or 6 quarters or so, rather. And actually, one of the problems now, I think, is that that's starting to spill over into the services sector. So if you look at the PMIs, these purchasing managers indexes, which give you a sort of snapshot each month of what companies are seeing going on, for services, they've tipped below 50 in both the Eurozone and in the UK. We have still got fairly high wage growth, so I don't think the ECB or the Bank of England are going to rush to cut rates there either. The situation looks pretty poor in Europe, I have to say.
Okay, so when we take a look more broadly, I guess, at economic growth, the fact that we are seeing that slowdown globally, interested then, Garry, given your research of what we see, how that relates to long-term equity returns. What's the correlation there?
Yeah, so what we find, and I think everyone's immediate reaction is that, if a country is growing very rapidly, you should invest in its stock market. We did some work recently looking at this over 100 years, and you find actually there is no correlation whatsoever between how fast a country grows and returns from its stock market. And you can see from the chart there, the R squared, the squared of the correlation is essentially zero. So a simple way of thinking about it is China. In the last 10 years, Chinese GDP growth has been 8% or so, but the Chinese stock market is basically no higher now than it was 10, 15 years ago. And the answer, so what does drive long-term returns is it's actually dilution. So if you look at that China example, what you find is although the economy grew and actually earnings grew, earnings per share did not grow. And so when a country is growing rapidly, companies need capital to fund that growth. And if they're not disciplined about how they use the capital, they just keep coming back time and again to shareholders and say, give us more capital, we need it for growth. So you get this massive dilution. So the key, and one of the reasons why the US has done so well, in the last 20, 30 years, has been buybacks. So US companies have on average bought about 2% of market cap in terms of buybacks of their shares. And even net, when you take into account net equity issuance, it's still, they have had negative dilution. So they give the money back to shareholders. In emerging markets, that number is about 6.5%. So on average, you get diluted away. So the bottom line is what you should look at is not economic growth, but strong corporate governance, companies that are able to grow without having to raise massive amounts of capital, that have got strong competitive moats, those sort of things. So the immediate reaction everyone has is, oh, a country is growing rapidly, that must be a great place to invest. That's quite clearly wrong from the evidence we showed in our report.
Yeah, I see that you break this down. You take a look at some examples there, particularly countries such as China, which you say has had outperforming corporate profits, but it's made for a poor investment. Why is that?
Yeah, so really is the profits versus the profits per share, so earnings and EPS. So earnings are fine, but they're not fine if you've got a massive amount of more shares, because if you're a shareholder in listed companies, that's just going to dilute you away. So that's the key thing to look at. So that's that net equity issuance that I talked about. So when you look around the world, what you need to look at is companies that are very parsimonious in the amount of capital they use, that have got good corporate governance, that only invest in projects that are going to give them good returns. And to a degree, what's been the problem in the past few years, we've had such low interest rates. The companies went and invested in anything. They didn't really have to think about the return, the profitability of their projects. They just threw money at everything. And so going forward, that's what we need to be focusing on, is companies that with interest rates so much higher as they are today, that can still find projects, investments that are worth putting into, even if you're having to pay, 7, 8, 9, 10% for your debt in that. So that's the key thing: strong corporate governance, strong focus on the profitability of investment.
Okay, so perhaps wary of extreme rates of equity issuance, but looking perhaps then at those net buybacks as a key.
Yeah, exactly. So, that's where, when you look at it, the US tends to be better. Companies there do have better corporate governance. It may also be the argument that you have much looser competitive environment in the US, where antitrust regulations are much weaker. You can have monopolies. Large tech companies have been allowed to buy their subsidiaries. So, that's why they've become very profitable. Europe, on the other hand, and Japan and emerging markets like China tend to be much more regulated. Companies aren't able to create the same sort of monopolies. So, a question that you can ask yourself there is, maybe from a societal point of view, what Europe does, which is being tough on monopolies, strict about data privacy, maybe that's positive. But from a point of view of stock market returns and companies' profitability, the more laissez-faire attitude of the US is clearly positive for companies' profitability, and therefore for the returns that shareholders can make from equity markets.
Yeah, so bottom line then, Garry is saying should be less focused on those forecasts of economic growth and perhaps take a greater look at net equity issuance.
Yeah, no, exactly. And, so if you take a country like China going forward, I mean, you could make a case that China's going to be very disappointing from a GDP point of view. Probably have time to go into this today, but I think, you could make a case that China can't sustainably grow its economy more than 3% a year. On the other hand, if it were, it is a big if, I admit, to get more focused on improving productivity, on companies focusing on profitable investments, on the government allowing the private sector to make more profits, despite that low growth, China could do well. So don't focus on China's growth prospects, focus on regulation, government attitude, the dynamism of the private sector, etc.
Garry Evans from BCA Research. All right, we are expecting a lower open when we get going in just a few minutes' time. There we go, we're off around a 50% on the SPI futures. Just a reminder too, registration's still open for our next virtual investor event, 11 a.m. today, it's Eastern. Small Caps Big Ideas. It'll be bigger, better and faster this year. We bring together 10 of Australia's leading small cap fund managers to each present one high conviction idea. And this year, throwing in a fast and furious special edition of The Call featuring micro caps chosen by you. You can register to watch or on demand at ausbiz.co/smallcaps23. That is ausbiz.co/smallcaps23. That is the global view. Stay with us. The open is just around the corner.